Okay, so top stocks. Let's just have a little conversation on what do we mean by top stocks. So let's go ahead and pull the chart, Jake, that I think is one of our favorites that we've used here. Now, when we're talking about a top stock, we're essentially talking about those with the largest market capitalization. And when we talk about market capitalization, it's taking the number of shares out there times the price of a stock, and that gives you its market cap. It's essentially what the market is telling you these companies are worth. And what we've done here is we've gone back over time and said, what are these top companies that existed back at these particular dates? So let's say you go to the far left there in 1930. As of January 1st, 1930, these are the largest 10 companies, starting at number 1 down to number 10, based on market capitalization at the beginning of 1930. And then that's what we've done for every decade. It's just taking the top 10 stocks beginning that particular decade. And then if you go to the far right here, you'll see that's where we are starting this year, 2025. These were the largest 10 companies as we begin 2025. Now, if we extend that a little bit more, and you're going to hear a common theme as we go through this today, this idea of a top stock. How do you become a top company, a very valuable company? Well, you've got to have some really good performance. And so let's take a look at the performance of the top companies that existed here going into 2025. And we're looking at the returns here now over those top companies from the last 5 years. So kind of going back to that theme here of you need really good performance to become a top company. And that's what we're seeing right here. This has just been fantastic performance, Jake. And that's where we say it's kind of a fun conversation. As an investor, I will take these returns any 5-year period as long as they're there.
All day long. You're spot on with that, Mark. I see these returns, they're jumping off the page to you. They're great. And I think an important thing to note is, and you hit on this, as an investor, we should be happy about this because in a diversified portfolio, there's a decent chance you might have had those in your portfolio. But also remember this, that anytime we look at the market return, it's driven by a subset of stocks, meaning when we have a really good run, it's not 100% of the stocks in the market that are delivering those returns. It's a smaller subset that is almost always driving the overall market return. So what we see right here, maybe not that surprising that there's a handful that have been carrying the market forward.
There's been a lot of attention around those handful of stocks. Some people have called them Mag 7, but the common denominator there has been this idea of these tech stocks. A lot of innovation, a lot of inventions coming from these group of stocks. And just think about that for a moment. Think about our ability as a consumer, where we can go out there, we can order anything, and it's delivered to our doorstep. I can go buy a pair of shoes, I can buy tools, I can buy a piano, I can buy a barn, have that delivered to my house. And what an incredible solution that is. That's something Sears Roebuck and Company was doing over 100 years ago, Jake. In fact, you could buy a house. They had these kits. You could order 100 years ago, have it delivered to where you live and build this house. So I think about a company like Amazon, this idea of a technology company. Their model has existed for a long time. Sears used to do that over 100 years ago, but they've made it obviously much more efficient, much more effective than we have today. Now, one other thing I want to highlight with technology, with what we've seen recently, is it new? In terms of the impact we've seen with technology and these really, really strong returns over time on a particular subset of stocks, like you mentioned, Jake. So let's take a look at that. Let's go back in time and look at a couple examples here. To do that, I'm going to go back to the period 1960. And if you'll notice on that yellow dot, that is IBM, International Business Machines. And IBM became a top company at the beginning of the decade in 1960. Now, what do we say to become a top company? You need really good performance. So let's take a look at the performance of prior 10 years in the 1950s and take a look at what that was. And what we see here, there at the bottom, in fact, we circle it just to highlight that a little bit. IBM annualized return over 10 years of 30%. Incredible returns. Very similar to some of the returns we were just looking at in our current top stocks. And it heavily outperformed the S&P 500 at that time by about 11% annualized. Again, so really good performance there in the 1950s. IBM became a top stock. And if you notice then, it stayed a top stock. It went up there to be the top company for about 20 years and stayed in as a top 10 company for many, many decades. Now, here's the thing, Jake. We talked about sort of technology and some inventions. I want to read to you some of the, I'll say, innovations that IBM delivered on over this time period we're looking at here. And then based on that, I'm going to ask you your expectation of what their stock performance would have been. So let's just go back here. IBM, some of their innovations, programming languages. They founded Fortran, COBOL, SQL. They developed the magnetic tape storage. They developed mainframe computers, the hard drive, the DRAM memory, obviously the electric typewriter, which avoided a lot of jamming, speech recognition in the 60s, magnetic strip technology we see on credit cards and things. The big one, a personal computer in 1981, the floppy disks, excimer laser surgery, 1981, silicon chips, 1994. Now, here's an interesting one, too, Deep Blue. Deep Blue, talk about AI, that beat Kasparov in the game of chess in 1997. Watson won in Jeopardy in 2011. So, Jake, with all of that incredible innovation that really has impacted our life, probably all of us, every day throughout society, what's your prediction? How would you have thought IBM would have done with those inventions?
Well, I think ahead of time, when you hear those headlines, then you know the impact that it had on the economy, on different companies, on our everyday lives. I mean, major breakthroughs. You'd be tempted to say it's going to have very outsized returns. It's continuing with that innovation, and I definitely want to make sure I have that in my portfolio.
All right, so let's see how some of these incredible innovations did over that 50-year time period. And, 9.8%, which is not a bad return. I'll say very market-like. It looked very similar to the S&P 500 over that particular time period. So it's kind of interesting how you can be a top stock for long periods of time and have market-like returns during that period. And then if we look at the next 15 years here, just keep in mind as we reveal this, again, IBM's been significantly working on quantum computers, supercomputers, AI, a lot of things around development of chips, things like that. In this case, underperformed the S&P over that time period. So, I think about something like this. A key takeaway to me here is you can be a top stock for long periods with market-like returns, but it's also really hard to stay a top stock. People are coming after you with competition, innovation. If management makes a couple, I'll say, weak strategic decisions, regulatory concerns, all these things come into play where people are coming after you, tough to keep your status as a top company. So that's how I think about kind of experience like IBM, Jake. What do you think of that?
Let's break that down just a little bit, because as IBM is an innovative company in the 50s, in the 60s, as it becomes the largest stock that's out there, as for a period of time it did actually outperform the market, what's happening? Well, what's likely is the expectations that the market's pricing in for the performance of that company are going up and up and up. It has greater expectations, and therefore that could be one of the reasons that price has gone up a lot more relative to the rest of the market. So it's not that it wasn't an innovative company or a dominant company or for a period of time the biggest company that was out there. It was what the market thought that company should be doing. The expectations were really high. And to Mark's point, you've got this combination of, you got heavy competition, potentially regulation, lots of things that are happening, and the market's already priced in really good returns. So when we think about it that way, maybe we shouldn't be surprised that it had returns that are in line with the market. And I want to take that line of thinking of, hey, we're looking at this individual stock, and let's go back to our group of top stocks and say, well, what if I invested in the group of top stocks compared to just investing in one company, in our example here, IBM. So if we take a look here, we'll go back and we'll take a look at sort of those top stocks for the period of time from 2020 to 2024 here on screen. And you ask yourself, well, what if I had invested in those? How would I have done? And what you can see right here is those top stocks over the last 5 years would have beaten the market. Okay, that's great. So I would have been better off by investing in the top stocks compared to just a broadly diversified portfolio. Okay, so one for one there. How about the 5 years before that? Okay, I won, again, top stocks do a little bit better than the market, 2 for 2. How about the 5 years before that? Well, the market does a little bit better. 5 years before that, market kind of wins again in the 5 years before that. So I'm 2 for 5 over this period. And we've actually run this back for 40 or 50 years. And what you see by just breaking it up into 5-year increments is that these top stocks do better about half the time, and the market does better about half the time. So it's sort of like a coin flip on what's truly going to be a better investment approach. You got to be careful saying, should these outsized returns that I've seen recently, should I think that those are going to continue indefinitely into the future? And in fact, if you say, let's play the game of every single time a company becomes a top 10 company, what do we see? And that's what we're looking at right here on this side. So the first bars I'm showing you are before they become a top company, and how do they do relative to the market? Remember, everything we're going to show you on this slide is relative to the market. So the 10 years, 5 years, and 3 years before becoming a large company, they do really, really well. That's literally the only way you get to be the top companies that are out there. Now, once they enter, so what we're looking at here is from the very first calendar year they're in the top 10, how do they do on average? And they have market-like returns, if not slightly below. So we were kind of showing you some anecdotal information there about IBM and the most recent top stocks. This is a very systematic way to do it, to say, what if you do it for every single time a company becomes one of the big stocks?
Let's look at a longer time period and see if there's anything there we can look at that might help us make good decisions going forward. Here's the question. What was the best performing stock over the last 25 years? So big reveal, it's absolutely NVIDIA by a lot. So the best performer last 25 years is NVIDIA. And let's just take a look, I'll say the magnitude of this performance. So what we're doing here, when we're coming up with the best performer, we're looking at cumulative return. And just think about that for a moment. NVIDIA over the last 25 years, up almost 150,000%. Decker shoes up 139,000%. But kind of interesting. You come back to some Taser military equipment, of course, Netflix. Who would have picked a Freightliner as the sixth best performer? So you kind of go down there and you see this. So I just love this comparison here because, yeah, there's some innovative tech companies in here and there's some standard businesses in here as well. Now, here's the good news of this, Jake. In fact, I say good news. It's outstanding news. I owned NVIDIA that entire 25-year time period, and I love it. I own Deckers. Turns out I own Monster too. So you see where I'm going. And I did. I owned all these companies in my globally diversified portfolio. And I see these kind of returns, and I love being a globally diversified investor, capturing these things when they hit. Now, let me go back. I want to have another comparison here. So Microsoft went public, I think sometime in 1985. Now, there's another company that went public not too long after that in 1986, Ross Clothing Store, Dress for Less. Ross. I think it's ROST is their symbol. But so let's look at their returns from 1987, because that would have been their first common year of returns, depending on when they went public. So 1987 through 2016, 30 years. And we're going to look at the returns here. Now, Microsoft, I think we all know, had a pretty nice run there. They were up 23.4% annualized over that 30-year time period. That's pretty phenomenal. And again, as an investor, I'll take that all day. What about Ross, Dress for Less? 23.4%. Exactly the same over 30 years. Again, phenomenal performance. Now, here's why I love this example, because again, we have so much conversations around technology and of course, Microsoft and their operating systems, I'll say change the world. But do you think it only benefited Microsoft? Or maybe that technology benefited Ross as much as it did Microsoft, meaning think about the inventory control, the insights they have between locations across the country, which stores are outperforming, what's selling hot in one area versus another. It probably helped them become an incredibly efficient, well-managed company as well, delivering those kind of returns. So that's sort of my key takeaway there, Jake. Technology stocks, you love them, you love the returns, but they also benefit a lot of other companies as well.